Thank you all, ladies and gentlemen, for joining us this evening. In such trying times for investors, Mr. Ang Chung Yu, our Fixed Income Division Manager, will share his views on the ideal course of action for long-term investors in such a market environment, while also highlighting factors and ideas that bond investors should consider. So without further ado, please help me to welcome Mr. Ang Chung Yu.
Hi, good evening, everyone. My name is Chung Yi, and thank you for joining tonight's webinar. I think as mentioned by Jonathan, we aren't in normal times, so I hope you and your family are safe and well during this lockdown period. My presentation tonight is basically based on an article I wrote a couple of weeks ago, which talks about the current market environment, some of the things we know about the situation, some of our guesses, and what we think is impossible or hard to know. The article also highlighted a few of our favorite bond ideas after the sell-off. And then I've thrown in some additional content for this presentation to express my gratitude for your joining us tonight. So I'll start with some facts about the current situation. Both equities and bonds saw their worst quarterly performance in the first Q since the 2008 global financial crisis. And obviously the sell-off was in response to mandated lockdown measures imposed globally, because these containment measures are equivalent to putting the economy into a coma. And nobody knows how fast the economy can restart after this, and how soon can it return to pre-crisis level. But I think the more important question for investors is, after the sharp decline in financial asset prices, has the market become cheap enough even with the expectation for recession? And I'll try to answer that later. So I'd like to look at the volume of new bond issuance as an indicator of investor sentiment. And broadly speaking, new issue volume in Asia has slowed to a trickle starting in March. For Sing Dollar, the new issue volume since March was the lowest since GFC. So I take this as a sign that the risk appetite in Asia is very low, which is usually a good thing because we should be more aggressive when the market is scared and things are cheap. Another fact about the current situation is that obviously, I think the world economy will be going into a recession this year. And the chart on the left here shows some of the early pain we have seen with both China and the Singapore economy shrinking significantly in the first quarter. For China, it was the first ever contraction since they started to report GDP. And IMF projections, as shown on the right, are telling us that the world economy is likely to go through a recession at least as bad as 2008. So a frequent question that I've seen is that what is the exact impact on GDP this year, and how long will the recession last? But unfortunately, my opinion is that nobody has the correct answer. We are looking at one of the greatest economic contractions in modern history, along with unprecedented government and central bank stimulus, as well as the greatest oil price decline ever. I think it is impossible to predict how these factors will interact with each other. And if I'm experiencing something that's never been seen before, I think I simply can't say I know how it will turn out. Another thing we know is that with the economic recession and the associated pressure on cash flows and earnings, corporate default rate will climb. And all the big three rating agencies has forecasted higher default rates. For Moody's, they expect the default rate of high yield issuers to rise to 6.8% if the downturn is sharp but short, and 20.8% if you experience a recession that's more severe than 2008. Next, as I mentioned earlier, governments worldwide have announced an unprecedented program of stimulus, support, and regulatory relief. I've highlighted some examples here. Just now I've said that the global lockdown measures are equivalent to putting the economy into a coma, which has never happened before in our history. So you can look at these stimulus packages as a life support for the patient so that the economy can bounce back after the shutdowns are lifted. Another one of the few things that I'm sure of is that prices of financial assets are a lot lower than pre-crisis level. The current financial market turmoil has wiped out years of gains in a matter of weeks. And from the fixed income market perspective, credit spreads on corporate bonds have widened significantly, especially for high yield credits as shown on this slide. What this means is that investors are getting paid a lot more for taking on credit risk. Moving on to the things that I don't know. Firstly, when will the world be able to get the disease under control and for people to get back to work? How many people will the virus infect and kill? You probably have seen many estimates from different scientists. and their predictions can be very different from each other. I have listed some examples here. But in any case, even if we assume that the shutdowns are lifted tomorrow, will any one of us immediately go and take a flight? And how will we react when we go back to work and one of our colleagues cough in front of us? Also, will we prefer to eat at places where the servers wear masks? I think questions like these suggest that even if our government removed the quarantine, we probably won't return to our former habits immediately. So I think the opening of the economy is likely to be gradual and in phases. Next, with central banks and governments racing to deliver stimulus, are these measures enough to prevent the economy from unraveling? I think it's still too early to have an answer for that, and the effectiveness of economic measures will vary a lot by country. So I've taken the US as an example here. The graph on the right here shows that previous rate cutting cycle goes about 500 basis points. So the 150 bips cut by the Fed in March is likely to be less with its impact. Also, even if the governments, assuming that the governments can simulate the effect of the economy by writing everyone a check for as long as the shutdown measures are in place, we still need to produce the actual goods and services that money buys. And just like there will be side effects if a patient is put into coma for too long, there's also likely to be an impact on the world's productivity if we stop functioning for a prolonged period. Next is the million-dollar question: has the market bottomed? My own view is that just like any other market crash, it is impossible for anyone to know whether markets have bottomed. For us to guess correctly, we not only need to predict when will the disease be under control, how fast can our economy restart, and also how investors will react to all the news that appear in the meantime. But my own guess is that we are unlikely to have already gone through the bottom of the current market crash, especially for the US market. As shown on the chart here, although declines in the US stock market have been sharp, almost all of the downward movements were followed by substantial gains. In fact, in early April, US stocks posted the biggest weekly gain since 1974, even though their weekly unemployment claims are still running at 10 times the all-time record. So I see that as a sign there's still some optimism in the market. But anyway, I personally don't invest based on whether I think markets are at the bottom. I prefer a more reliable approach, which is to think about whether I can assess value cheaply at current prices. That means, am I getting paid well in terms of the future cash flows for my investments relative to the price that I'm looking at? Moving on to some of my guesses. There have been many comparisons between COVID-19 and the Spanish flu, but I think it is unlikely that COVID-19 will take over the title of the deadliest pandemic in modern history. I like this picture here because I think it provides a good visualization of pandemics and their death toll. Spanish flu is the big green ball on the top row, and COVID-19 is a tiny circle on the bottom row. My wife is a doctor, so she always disagrees with me when I talk about this kind of statistics because she feels that I'm downplaying the severity of the situation, but I'm not. I mean, I agree with the medical experts that COVID-19 is a new virus and a huge threat because the world is vastly more populous and interconnected than before. But as a financial analyst, it is my habit to put things into context, which is what this picture does. And more importantly, I think even in the case of a Spanish flu, which killed more people than World War I, it did not decimate the business world and the economy eventually recovered. Okay, although I said earlier, I believe nobody knows whether markets have bottomed, I think current valuations are telling us now is a good time to invest. It may not be the best time because, like I said, prices may very well move lower, but I don't have the ability to predict market movements. So my recommendation is to buy when we see bargains. And I think there are certainly a lot of opportunities in the market today, especially in Asia. Like for instance, Asian high yield. I think their credit spreads are now around double digits. If someone buys a diversified portfolio of high yield bonds at current prices, it will take a lot of bad things to happen for him to suffer large losses. This chart here shows the historical default rate of Asian high yield bonds. I think even if we take the worst case scenario of Moody's, which is that the default rate jumps to 21%, which by the way never happened before, defaults at that record level have to happen every year moving forward and not just a single year for a diversified high yield investor to lose money. Okay, I will next highlight some of our favorite bonds at this point of time. But before I start, I just want to share with you a story because I felt it perfectly illustrates the typical behavior and mindset of an investor. So in the middle of March, my boss texted a client to let her know that there's a bond yielding around 7 to 8%, and it was previously yielding about 2+ before the virus. So he was asking whether the client would be interested. The client said no, the bond is trading at a distressed level, so it's too risky for her. And then in the middle of April, the same client came back to us and asked whether the same bond had any liquidity because she felt it looked attractive at current prices. By that time, the price already went up by more than 15% and the yield was just around 4%. So my boss got curious and asked, hey, why were you not keen? When the price was much cheaper. Her reply was still the same because it was trading at a distressed level and now it is not. I felt that wasn't a logical answer because it meant she would prefer to buy when things are more expensive. But at the same time, that is a very common response. That as much as we want to buy low and sell high, we usually do the opposite in a crash. So most of the bonds I'm about to highlight here might not have very exciting yields, but I have focused the list on issuers that have the financial firepower to survive the global pandemic. And investors should be able to remain calm and not sell even when the bad news come in. So the first bond is HSBC Perp Callable in 2022. If called, the yield will be around 7%. There have been quite a number of negative headlines surrounding HSBC, and I've listed some examples here. The headwinds actually started last year when the big three rating agencies all took some form of negative actions on the bank's ratings. The downgrades were mostly because of lower earnings expectation and uncertainty surrounding HSBC restructuring plan. And you probably have already heard about the bank cancelling this year's dividends. Another factor that weighed on most bank perps was that since the crisis, analysts have been highlighting the risk of bank AT1s or CoCos, like the lack of maturity date, the absence of step-ups, and the fact that banks can defer coupon payments. Although I personally find it curious that nobody thought about these features before the crisis. I think the 7.2% yield to call is a good reward to take on this risk. Even if the rating downgrades, HSBC is still one of the world's most highly rated banks. Also, the suspension of dividends came after a formal request by the UK financial regulator to all major UK banks, and not because HSBC is in a liquidity crunch. In fact, if we go by its capital ratios, the bank is in a historically strong position. For more conservative investors, I think the DBS USD Perp is a good alternative. The bond price has went up quite significantly in the past couple of weeks. The yield to call has dropped from, I think, 6+% to 3.8%. But even at this level, I think it is still decent, considering that it was yielding a low 2% prior to the pandemic. I'm confident that the Singapore banks will be able to ride out the economic recession because macro indicators such as Singapore's credit to GDP gap and loan growth are showing that the amount of leverage in our financial system is low. And because of the healthy financial system, MS has said that it does not need to restrict dividend policies, unlike many other countries. DBS is also very profitable to the extent that I think even if loan loss provisions were 3 or 4 times 2019 levels, it will still record positive earnings. And unlike UOB, it has a smaller exposure to the SME segment. The next bond is the 4.8% US dollar bond of Press Metal. This is a Malaysia company and the largest aluminium producer in Southeast Asia. Previously, the bond was trading at around par. It is now yielding 14%. One of the reasons that sent the bond price plunging is obviously the lower expectation for aluminium demand because of COVID-19. And aluminium prices had already been falling even before the crisis, mostly because of the US-China trade war. I think the sell has been excessive and Press Metal should be able to outperform because of its cost advantage. Due to its large scale, the company is in the first quarter of global aluminium producers in terms of its cost. So I think it's likely to remain profitable even under these circumstances. Press Metal also has adequate financial liquidity from its credit facilities and operating cash flow. This next bond is another US dollar bond of Season Group. This is a residential property developer in China, previously known as Future Land. The main operating subsidiary, Season Holdings, is the number 8 property developer in China in terms of overall strength. Even if you don't know much about the company, you might have seen somewhere the headlines about its ex-chairman being arrested last July for child molestation. The company's stock and bond prices immediately tanked after the incident. But I think the management has responded well, and Season managed to achieve its targeted contracted sales of 270 billion yuan last year. In fact, its balance sheet is now much stronger than before, with its cash alone covering almost 75% of total debt, and contracted sales are much higher than borrowings. I also like that management has seemed to have taken on a more conservative financial philosophy, probably because they wanted to reduce risk to prepare for the management transition. They have announced an asset disposal plan last year, which should further improve the company's liquidity position and leverage. This is the 2022 SGD bond of ESR Cayman, a logistics property company that IPO in Hong Kong last year. I like that close to 60% of its assets under management are located in China, Singapore, and South Korea, where the governments have been relatively more successful in containing the virus. Also because its portfolio is predominantly logistics properties, and more than 60% of its tenants are e-commerce and logistic company. I think so far there has been minimal disruptions to its business. I also like that ESR Cayman generates a substantial portion of earnings from its fund management business, which has higher margins and lower capital requirements. If I exclude fair value gains from the investments and development segments, the fund management business generates about 40% of the company's operating profit. The next bond is from Singapore's largest telco, Singtel. I know the yield may not look very exciting, but to put it into context, the credit spread of this bond is almost double the pre-crisis levels. Despite increasing competition in the domestic market, Singtel's credit metrics remain strong. Gearing as measured by both net debt over equity and over EBITDA is low, and interest coverage is high. I think the liquidity position is also comfortable, with around $3.6 billion of free cash flow expected in the current financial year, including dividends from regional associates. The company had just around 3.3 billion of short-term debt. The last bond idea that I'll talk about is the 2022 SGD bond of Olam, right now yielding about 6%. This slide shows the substantial shareholders of Olam, which is one of its primary credit strengths, because it has Temasek as the biggest shareholder at more than 50%. But if I remember correctly, previously we have rarely recommended any Olam bonds, because I felt that the market was pricing in too much of a premium for it being a Temasek-linked company. And I think the yield was low relative to the company's financial health. So you might be wondering, why do I like this bond now? Because the bond price has plunged and the yields are now much higher than before. And I think the bond now gives good use for Olam's food and agricultural business, which I think should be resilient in this downturn. Olam also has a good financial liquidity, with more than 9 billion of unutilized bank lines and 3.2 billion of cash. Short-term borrowings were around 7 billion, and only around 350 million were bonds. The company has very strong access to bank funding and have built various channels like sustainability link and digital link loans. Olam's net gearing was stable last year, even though the application of new accounting standards added about 400 million of lease liabilities to the balance sheet. The company has plans to sell assets and release cash of up to $1.6 billion, out of which 488 million Sing dollar has been achieved so far. And that's it for my presentation. Again, thank you for joining us. I think, John, we'll move on straight to Q&A, right?
Yes, that's right. Right now, Mr. Ang will begin to field the questions in the Q&A section. If you have any questions, feel free to use the Q&A feature to put down your questions.
Okay, I'm just looking at the first couple of questions from John. Based on historical data of previous recession or crisis, what is the average default risk? In my opinion, would I expect higher default from COVID-19? I think part of the segment I talked about just now has partly answered the question. But to answer the first part of this question, which is what is the average default risk in the previous crisis? I think globally, in previous rounds and previous cycles of crisis, going back to the US tech bubble and in 2000 and the global financial crisis in 2008, I think high yield default rate was at about globally was at about 10%, and it was slightly lower for Asia, I think 9+%. So in my opinion, as I stated earlier, I expect because of capital markets right now, especially in Asia, are very tight, and because of the cash flow pressure that companies will face, I expect the default rate will be significantly higher than before. So the second question was, as a bond investor, what would be the best strategy to safeguard against default? I think that's a very tough question to answer, and it depends on, I think, whether you are primarily IG investment grade or high yield investors. If you are primarily investment grade investor, my recommendation most of the time is to don't stretch your standards to get another 1 or 2% of you. Instead, focus on safeguarding your downside. That means go for credit quality rather than stretch for the additional 0.5 or 1% of you if you are primarily investment grade investors. For high yield investor, I think it is there's no magic formula to safeguard against default except better credit selection. But that depends on the research and the skills you have in terms of selecting individual bonds. But a simpler way to do this would be to structure, to buy your bonds in the form of a portfolio. So if you buy high yield bonds on average, I think the default rate for Asia was, for the very long term, was about 2%, slightly more than 2%. So if you had 100 bonds, you expect 2-3 of them to default every year. So to prevent any of the defaults to significantly impair your net worth, the recommendation is only to diversify your high yield holdings as much as possible, make it the supplementary portion of your overall portfolio. Okay, another question that was bumped to the top is, most of the high yield perp and Asian bonds are around 8 to 12% low. Is it time to hold or cut loss to sell? Okay, I am from my department mainly work individual companies, so it's quite tough for me to give a very blanket kind of statement. But I think generally valuations are looking attractive. I think as I mentioned earlier, credit spreads right now is at double digit, meaning you get paid more than 10% for taking on high yield kind of risk. And yeah, so the valuation is attractive to me. I think if you hold a basket of high yield bonds, it would be a mistake to sell them now at current prices. But if you hold if your net worth is significantly concentrated in 1 or 2 high yield bonds, it is very important to look at the issuer and see whether you have visibility into the liquidity. Like for example, I think I highlighted 7 or 8 companies earlier, Olam, Singtel, Pressmetal. These are companies that have the liquidity or the earnings visibility to let us know that they have the capability to survive within the next 12 to 8 months. If your bond investment do not have that liquidity and you do not have the risk tolerance, or you do not have the capacity to absorb default, then I would suggest you probably have to look elsewhere or cut your risk exposure. Next question. European bank cocoa bonds, is it now the time to invest or divest? European bank, that is a very wide category, but okay, I'll just talk about a few banks that we cover, like Deutsche, UBS, and Credit Suisse. I think if your concern is primarily about whether these AT1s will get converted into equity, I think the chances are very low. I think all the major banks that we cover in Europe have a significantly stronger balance sheet than the previous financial crisis. So I think it is a very remote scenario where the bonds will be converted into equity. But if your risk is whether the bank will suspend coupon or even extend the redemption period, that means not redeeming the bonds on first call, I think there's a real chance that it will happen for certain banks with weaker earnings and weaker financial ratios. But nonetheless, I think for banks like UBS and Credit Suisse, I think that is still not our base case at this point of time. That means I still expect the banks to pay, to not defer their perp coupons, mainly because if you take HSBC as an example, the stock price has tanked immediately after they just announced they will be suspending the dividends for the rest of this year. And it's not their intention, it's actually a request by the UK financial regulator. So when the stock price tank, it means that the bank's funding cost is a lot more expensive. It'll be a lot more expensive for HSBC to get funding, whether it's debt or equity. So I think the banks will generally not risk another round of bad sentiment from their investors if they announce coupon deferral, unless they are really desperate. But at their current financial ratios, I see that as less likely to happen. Okay, next question is, while the equity market has recovered quite a bit, but the bond market has not, would the recovery happen only when the economy recovers? US has supported its domicile company bonds, but do you expect other governments to support too? I think you need to be looking at specific markets. I think right now I see US market has rallied very strong, but it's not the case for Asia, or especially or at least not for the Southeast Asia and China markets. So would the recovery happen only when the economy recovers? No, I think typically, historically, financial market movements usually they tend to discount events 2 years into the happening, meaning that all the traders will try to guess what will going to happen in the next 2 years. So that's why you see a very strong rally in the US, even though things are weak and earnings are bad, and we still see the death rates going up. That's because the US investors are looking past all this negative news and expect things to look a lot more better 2 years later. So I think anytime you see a prospect in terms of whether it's the invention of vaccine or a gradual removal of the lockdown measures, I think you will see a recovery in the markets happen. About the last question, whether other governments would follow US in terms of supporting the bond market, I don't know. I think besides US, Japan has also do that. But for Singapore, at least I don't think Singapore government will do that because our Sing dollar market is very small. And personally, I'm opposed to the idea of doing this. I think there will be long-term repercussions if you do something like backstopping the bond market. That means you are practically saying it's okay for all the highly leveraged companies to take on debt when times are good, and then you build them out when times are bad. I think it would have some side effects when all the things clear up. I mean, in the last global financial crisis, one of the side effects is the rise in populism in terms of politics, and we have seen that until today. I mean, some of the arguments raised in supportive of the Fed buying corporate bonds is that the COVID-19 is nobody's fault. Nobody has predicted it, and because of that, the government should buy corporate bonds because it's not the corporate's fault. I mean, it's something that the corporate cannot predict, and it's not their fault. But I personally disagree to this opinion because whether you are managing a company or you're investing, I think you have to be prepared. I mean, we don't take risks just purely, mainly because we don't know what's going to happen. And I think you cannot support some companies for taking on excessive leverage just because COVID-19 happened. I see a couple of questions that are quite similar. So the questions around whether, at this current condition, should we buy a bond directly or a bond fund? Is it better for one or the other? I think just like in normal times, it depends on your needs and your objectives. If you have a need to control your cash flows and know precisely when your cash flow from investment will come in, then obviously individual bond is more preferable for your circumstances. If, for example, right now, if you see the valuations are very attractive and you want to take advantage of current situation, but at the same time you don't have the time to read maybe our research or do your own research into 10 to 20 companies, then but at the same time you want to diversify risk, as I mentioned earlier, then I think bond fund is a good alternative. But there are some downsides to that also, like the Sing dollar market. I like to use that as an example. if you have invested in some SGD or Singapore-centric bond funds, you might have noticed in March and April, even though the sell-off in the market has been very severe, your bond fund NAV actually didn't move much, or in fact have been quite stable or going up even. I think that's partly because the bond market is a lot more illiquid than the stock market. So a lot of times how the fund managers price their NAV might be based on steel prices, might be based on indicative prices that is not actually reflective of what the current reality of the market is. USD versus, the next question is I'm looking at is USD versus SGD bonds. As an investor, is there any consideration to look out for? Okay, to start with, USD market is a lot more bigger and a lot more liquid. So if you don't mind the currency exposure, your USD is always a better place to start with, because you get a lot more selections, and also in terms of trading, it is a lot more easier for you to buy and sell your bonds. Sing dollar historically has been dominated by the private bank market. I think over the long term, they have private bank investors have made up about 1/3 of the market. So typically, PB investors tend to buy and hold their bonds. So, and then plus the fact that SGD bonds are usually smaller in sizes, so they tend to be more liquid. Okay, next question I'm looking at is HSBC has announced no dividend to shareholder. Does this apply to the bond? No. The suspension is only on the equity side. Right now, I have seen no announcements or no signals from any of the regulators about the need to preserve capital by suspending AT1 coupons. Although, as I mentioned earlier, there is a chance that this will happen. But I think at current prices, for whether it's especially HSBC previously, at their prices, I think you are getting very well compensated for the kind of risk. Right, most of the bond ideas, there's a comment on one of the participants about that. Most of the bond ideas I went through are available on our Bond Express platform, except Singtel. So going forward, what other SGD bonds are I first evaluating and considering to include in Bond Express? The platform seems to be skewed toward high yield, and I hope to see more IG issues so that we can construct a more balanced portfolio. That is very good feedback, and that is something that I've often mentioned to the product management side. So for your information, I'm on the research side, so I don't have control on what is available on Bond Express. In terms of the selection, but the research department, that means my department, have control over the quality or the investment worthiness of what bonds appear there, because when the selection of those bonds are actually done by another team, or you can call them the sales or product team. So they mainly look through the research that my team write about, whether it is high yield or investment grade. They then think about what kind of client demand they will get from putting that bond on Bond Express. And then they maybe go and solicit some feedback from clients that maybe, our research team has written about this company, which would be interested. Then after that, they come back to us and ask us, hey, are your opinion still the same as your previous article? Is this bond still worthwhile to invest at current prices? Because it's not just about the credit profile, because the company may be a risky company, but we think the bond price is good, or vice versa. The company may be a very strong company, but we think the bond price isn't that attractive. So based on all these considerations, then the product management team would then select the Bond Express bonds. But certainly, I will emphasize again your feedback to the team. I'll let them know again, because it's something that I mentioned to them quite frequently, in fact. Okay, I see another question from one of the participants. The bond price dropped quite a bit due to COVID-19, and there's a liquidity issue in the market. The spread is quite big. I want to ask, how is the outlook for these bonds: Olam International, Keppel Infrastructure, Guaco Land Limited, OUE Treasury Limited, and ARA Asset Management? When will the price return back to norm Okay, there's quite a number of questions about company-specific questions. For Olam, I think I've just mentioned about it. I think our outlook on the company relative to the bond price, I think is good. Mainly because if you have, the company just announced that they have obtained another close to $200 million of credit facilities. So I think their liquidity is very good and they can certainly survive the COVID-19 pandemic. Coca-Cola Limited, I think one of my team members just issued an opinion on this company. You can refer to the article for more details, but in summary, the credit metrics remain intact. Not much changes yet. But I think the more important question moving forward is the 2Q and 3Q. How would that be reflected? I think right now it's still too early to say. But I think in terms of its credit profile, I don't think there's a near-term, there's a significant risk that the company will be significantly impaired by the pandemic. ARA, I'm sorry, but we can't cover this company because it is private limited and the company doesn't really disclose its financials, so we are unable to really provide much of a research coverage. I think the last available financials was June 2019, if I'm not wrong. So there's quite still in terms of the information. I see a question here. Are most of the bonds in denomination of Sing dollar 250,000? Yes, for Singapore bonds at least, yes. It would be mostly in denomination of 250,000, except for retail bonds like your SIA 3.03% or your Astral 4 and 5 bonds. Except for those retail bonds, most of the Singapore bonds are available in 250,000 sizes, except if you buy or transact in the bonds through our Bond Express platform, and if you are accredited investors. Bond Express allows you to trade the bonds in I think 5,000 sizes. Okay, I have an interesting question. How do I differentiate between IG and high yield bonds? I think for markets outside Singapore, that means for US, it's usually very easy. You just look at the ratings. Most US dollar bonds are rated, so the credit rating will tell you whether it is an investment grade or high yield. For the Sing dollar market, it is a bit trickier because most Sing dollar bonds are unrated. There are multiple ways you can do this. First, you can rely on the shortcut available on our website. If you go to either fsm1.com or bondsformat.com, the bond fact sheets will show you. We have a methodology of differentiating between IG and high yield bonds and then tagging them as such. I think the thing that you will see on the fact sheet is whether it is a stable income seeker or high yield. So that if you go to our website, that tells you whether the bond is IG and high yield bonds. Okay, I see another question here which is related to what my team recently wrote about. What is our opinion on the BreadTalk bond? Are current yields enough to compensate for distress possibility? I don't think F&B restaurant will recover anytime soon. Yes, I agree. F&B and restaurant will not recover anytime soon. But for BreadTalk specifically, the company is just the privatization of the company was just completed recently, and that would trigger delisting or cessation of trading put on the bonds. That means the bondholders will have the right to sell the bonds back to the company, and the company is prepared for this scenario. So I don't think there will be any issue for BreadTalk bonds. All right, next question. HSBC 4.7% perp. Is it IG or is it a high yield bond? Okay, I am answering this question based on my memory, so I might be wrong. HSBC, I think the issue rating is a single A, but the perp, hold on, maybe just let me pull out the information very quickly. Okay, sorry to keep you waiting, but yeah, the bond is also investment grade. So the bank is A+. The bond is rated a few notches lower at the BBB because it is a deeply subordinated bond and it has some AT1 features like the ability to defer coupons. So it's a BBB bond, still investment grade. Another question about bond trading. One of the participants observed that bond prices had dropped quite a fair bit. But when he checked with over the counter with his bank, the price is still around the same level as before, not much different. Why is this so? There could be a couple of reasons for this. First is that I think, as I mentioned earlier, if it is a Sing dollar bond, historically the bond prices have been prone to lag the overall bond market because a lot of our Sing dollar investors tend to buy and hold to maturity, so that there isn't a lot of activity in the place. So the bond prices tend to lag. And then other is the relative, that is related to the second point, which is the relative illiquidity of the market. And the third point is that your banker might usually charge you a spread on top of what he's seeing over the counter from his counterparties. So if you want to be sure that the price you get is fair, you might want to get 3 or 4 quotes from your brokers. All right, next question I'm looking at is with zero to negative interest rate environment, should we invest in government bonds, or the better option is to invest into corporate bonds with at least A grade? Well, I think it would be, I think at current prices for sovereigns, whether is it treasuries or the Singapore side, I think it would be long term. I think it would be a mistake to invest in sovereigns. If you look at US, it's close to zero. If you look at Singapore, slightly better, but not much better. With what do the government need to fulfill their fiscal stimulus measures, that they need to issue a lot more bonds and they need to print a lot more money. So long term, of course, it's not going to happen in the near term just because the economy is likely going to stay weak. But over the long run, I think the possibility of inflation and is a very real, and I think getting government bonds at the current price is actually very risky. Whether is it a better option to invest into corporate bonds with at least A grade? I think yes. I think as compared to previously, you are now getting paid a lot more for investing into IG. If I'm not wrong, the average spread for investment grade bonds is 250 to 250 bips to 300 bips, which is probably 150% or double the level of what you're getting previously. If I've skipped your question, it's because there's a lot of questions going on and I need to select those companies or those questions that I can immediately recall, so as to place all those questions that I think will have a wider applicability. So if you put in a question about a specific company, then I might put that in, I might put a lower priority to that because I probably don't know about the company because it's responsible by another analyst. But please feel free to get your questions down and either write into to our customer service or to your account representative, and we'll try to answer them accordingly. The next question is what about Virgin Australia, which is under judiciary management? What will happen to their bonds? It is very cheap. I don't know what will happen to their bonds. I think the most likely outcome for Virgin Australia is another airline coming in to take a majority stake. But I don't think anyone will come in at this point of time because they probably want to wait until some negotiations with the creditors and when the terms are good enough for them. That means they'll be hoping to buy Virgin Australia at a cheap price, just like any other insolvency cases. So what will happen to the bond? I think they will suffer a very substantial haircut. How much? I think according to rating agencies, they are putting a recovery rate of somewhere between 10 to 30%. Okay, there's a question here about bond fund. Why usually when interest rate go down, bond price should go up? So I'm confused why the price of a bond fund that I own went down instead. Okay, so interest rates have moved down, you're correct, whether is it in US or Singapore. But the movement in interest rates is a lot lesser than the movement in credit spreads. So when you buy a bond on the bond fund, you get a yield. That yield is made up of primarily two components. One is the benchmark interest rate, or usually the risk-free rate. Another component is the credit spread, or what you get from buying a bond that is not risk-free. So the movement in the first component, which is the interest rate, has gone down, yes. But at the same time, credit spreads have gone down, has came out a lot. So that makes the yields higher than before, even though interest rates are lower. So that makes the bond price lower, and that makes the NAV of your bond fund lower. I think I will take the last three questions. For the rest of the questions, as I mentioned, please feel free to write into your account rep or to our customer service. For someone who is new to trading bonds, what is your advice in the areas to look out for and the pitfalls? Okay. I think first and foremost, I think you need to be sure of what is your investment objective. If you are looking for a stable income of, let's say, 2 to 3% or 3 to 4%, I would my usual advice is not to stretch your standards, not because your relatives or your friends are earning 6-7%, then you go for higher yielding bonds. Please don't do that. Instead, think of what is your investment objective, and then invest according to your risk tolerance. So what are the areas to look out for? You have to understand the company that you're investing in. I think, like for example, we see there's for 2 years already, we have been seeing Australia bonds from Azealia. I think a lot of people buy into those Azealia bonds, even though I personally like the bonds, but not necessarily because they know the bonds and the company. They buy it because it is there's a Temasek brand linked to it. But it's actually a very complex bond. It is a private equity bond. So I don't think a lot of investors out there know the product thoroughly, but they buy it because the yield looks okay and is issued under the Temasek Link company. So my advice is, if you buy a bond, be sure that you understand the company and the issuer and what is its credit profile. And if you're buying high yield, I think my usual advice is you should be able to buy a portfolio of high yield. If you're buying a single high yield, I think the proportion should be a small part of your overall portfolio. Okay, next question. Since USD bond market is bigger and more liquid than Sing dollar bond market, can we say that USD bond prices will be closer to market price? Okay. Yes, I would say yes. I think you can just look to the companies that have both US dollar and Sing dollar bonds, like I think DBS. If you look at DBS, the USD perp just now, I pointed as one of the bond idea. I think in middle of March, when the sell-off was severe, I think the bond price was yielding around 7% for a DBS bond. So on the Sing dollar side, I think you're looking at maybe 4 or 5%. So that tells you that usually the USD market reacts faster to the market news and the fundamentals, although they might not necessarily be correct, but they respond faster. Okay, I've taking a last question here, which is what is the maximum leverage I would recommend when investing in high yield bonds? I personally don't recommend. I think you're referring to the leverage you take on your trading account. I personally don't recommend taking on any leverage when you're investing in high yield bonds. I think it's fine to take on some leverage. In fact, I think it's a good investing option if you are able to take on leverage when you're investing in IG bonds, because the track record over a very long term is that if you invest in IG and you move the yields out by taking on some leverage to move it closer to high yield, the risk-adjusted return is actually much better if you compare it to high yield. But if you are investing in high yield bonds, I don't recommend taking any leverage actually. Okay, that's it for the Q&A session. John, you have anything to add?
Thank you so much, Mr. Ang, for your time this evening. And sorry that we were not able to get to everybody's questions, but thank you for your kind attention. What we will be doing is to record this webinar, and when it is ready, we will be looking to post it on our website at fsm1.com. So thank you all for your kind participation this evening. We have come to the end of the webinar.
Thanks again for joining us.